And the first guest that we have on the show is Unmesh Sharma from HDFC Securities. Unmesh, real estate index is going to go down as one of the big winners of 2023. It's up more than 75%, inching towards an 80% rally. In the real estate basket, if you had to pick one winner for 2024, which one would it be and why?
Thanks. Good morning. Yeah, it has been a big winner, but as per our view that we have even expressed before on this show, real estate, has a double benefit going for it. One, obviously, being the fact that we are in a multi-year cycle as far as real estate is concerned, because there is an underlying asset class as well. And then there is the peak of the rate cycle sometime during this year as well. So that is something which should help. Now, you put that into context, it's not in the index. So when you take a position in our model portfolio for real estate, you have to be going off index. And yet we have a 2% kind of position in Sobha. That is a one stock that we believe will be, continue to do very well for the year 2024 as well.
Why Sobha developers over the others?
So one is, the relative valuation is one, but more importantly, if you look at the home market where they have, we are the most excited as far as the growth for them to, is concerned. Residential, in any case, we are a little bit more positive than commercial. So that's the reason why we prefer Sobha. And that's at this point in time the only position that we have in real estate in the model portfolio.
Okay, Unmesh, hi, season's greetings to you. Well, I don't know if you're planning to celebrate and take off in the new year or not, but it's been quite a phenomenal 2023, right, for the markets. So slightly broader question, are you expecting this kind of generosity to continue from the street as we step into the new year, especially given how strong November and December have been? Or do you think that investors need to brace themselves for maybe some consolidation or maybe, a bit of profit taking?
Yeah, so look, 2024, not expecting to be a straight line, like we saw last year. Of course, last year also we had expected some volatility, but there are a few things which have surprised us. One, and I think where the stress, so as to speak, could come from, rather the source of volatility could be, the positives are well known, okay? The fact that now more and more there is a conviction that we will have a stable government. That outlook, I think, has reduced. Generally, the commentary from the Fed seems to indicate that the market believes that the peak of the rate cycle is here, with some rate cuts happening maybe second half of next year. So and oil is benign. So if you put all this into context with our external vulnerabilities much better than where they were in the past, India seems like a nice market. Okay. At the same point in time, the flip side is that there is a lot of discomfort on valuations at 21.5 times on the index for FY25. And on top of that, now what will end up happening is we expect there to be kind of two waves of buying. One in January when the asset allocators start looking at countries again. So we should see some index buying at that stage. And the other is, post-elections, if indeed the election results are the way in which the opinion polls are predicting at this point in time. But in the interim, what we believe will happen is that, the incremental triggers will have to come from single stocks as far as earnings and delivery is concerned. So apart from the macro factor, which should play a part very early in the calendar and somewhere in the middle of the calendar, what we believe is that, rubber would hit the road somewhere in the February to April kind of time frame, which is where we expect that, only companies which will deliver earnings are the ones which will do well. So it was not going to be a straight line, unlike what we saw in 2023.
Unmesh, one of the other recommendations from HDFC Securities is MCX. We were chatting with the MCX management earlier in the day, and they were saying that the software costs, which hurt them so far, will be under control going ahead. They're launching new products. I think steel rebar gets launched on the 15th of January. And plus the options, volumes have exploded in the market, so they're benefiting from all that. The question is, but has the stock priced in all the positives, given the run-up that we've seen in MCX? And what could be the potential stock drivers from here?
Yeah, so look, I was watching that interview with a fair bit of interest in the morning. They've spelled out what has happened, and I think steel and all this is a positive. The software issues are also in the past. The stock has gone up to 3,200 or thereabouts. And to some extent, if you look at the very immediate term, I think it could take a breather. But what you have to consider at the same point in time, one is that the participation on the index itself is a long structural theme. The financialization, so as to speak, of the markets. The other is actually two interesting factors that we would keep a close eye on, which we believe will play out. So since you're asking me what are the drivers for 24, what we believe, one is that if they can get the monthly contracts but expiring every week, there will be a product offering every week on this MCX, which should drive volumes to the market. Just like what happened with the stock markets with pretty much one very liquid options, F&O kind of expiry happening every day. Similarly, we should see that happen over there. And the other is that the non-deliverable contracts are the ones. So if you look at oil, gas, where there is no promise of delivery at the end, is where the more and more products are introduced. There are the ones which actually drive the long-term growth. We believe this will play out in 24 along with the long-term structural theme. So continue to remain long. It remains in our model portfolio as well with a 1% weight, which again is off index. So yeah, quite positive on that.
Okay, so that's Sobha, MCX. Let's come to the third pick for 2024 Unmesh, and that's large cap banks. I think that's become a bit of a consensus move now in the market, right? Yeah. Everyone's expecting the bank rally to kick off, and we saw a little bit of a glimpse of that in December. But let's get a little more granular. I mean, are you saying buy them as a basket? The entire lot will move up, and within that, what would your preferences be between a Kotak, IndusInd, etc.?
Yeah, so look, it's become consensus. We went early, so luckily our research team's model portfolio has done quite well actually second half of this year because of to some extent that we can't comment on our parent bank. So among the larger banks, what we have equal weight is on ICICI Bank. That's more valuations, but still positive. State Bank is an overweight, and we've kind of taken a positive on Axis and Federal. That's how we are playing it. What you will notice is you could have a little bit here and there, but the point is that the core theme continues to remain one, that relative value in large caps. The second is that all the emergent risks which may come through, including what has been flagged off by the RBI governor, is to a large extent in the in every cycle what happens is that there is always one tail which kind of takes the brunt. So if you remember in 2001, it used to be, SBI and the PSU banks. Then there was the small private sector banks, the large private sector banks, the NBFCs, the mutual funds and so on and so forth. This time it could be the fintechs, it could be the space where BNPL and all of these are done. So if you take that into context from the rate cycle perspective, we believe that we are in a good place. Relative valuations are better. If my thesis is right and we see more FPI inflows happening in the first quarter and then in the second quarter of the year, that's usually more beneficial for the large liquid banks. So technically as well, there is that factor. The valuation gap is not the same as it was before, but it continues to remain there. So if you are building a model portfolio, assuming, flattish kind of returns for the year, I think and this is a large sector, so you can push in ample amount of liquidity in. Why would you not be overweight large cap banks, even though it's turning out to be a consensus? I would still remain there. So, this is how we play that.
Absolutely. And if December is anything to go by, the kind of FPI money that we got in, that deluge of 57,000 crores, if that continues, then it's I guess it becomes a bit of a no-brainer idea to must have in your portfolio. Thank you very much, Unmesh, for joining in. Great having you throughout the conversations in 2023. Wish you a great end to 2023, and look forward to our conversations in the new year as well. Well, thank you. That's the view from HDFC Securities. We have